$4 million. The public count is knocking on that door. $4 million. Come on, baby. We're so close. Congratulations to everyone watching this right now who is super close to an all-time high in your portfolio, or maybe you hit an all-time high here today. Congratulations to all y'all. Congratulations on making some phenomenal gains out there. Google stock. Oh my gosh. I had to reference this one. It is blue hot right now. It is so on fire. Elf stock, by the way, is on fire as well. But Google stock, look at this. I mean, this stock now up 59% for us. And for a relatively new investment that, you would look at Google as just like a very, I guess you can say safe company, and it's just performing tremendous. So Google cannot be more happy with that share price performance. The Nasdaq's at all-time highs. Some people think there might be no opportunities in this market. And here today in this video, I'm going to tell you there's a lot of opportunities in this market. You just got to know where to look in this market for opportunities. Because people think like, oh, all-time highs, there's nothing to buy, everything's overvalued. No, not so fast. There are some stocks that are certainly overvalued in this market, but there's a lot that are huge opportunities to make a lot, and I mean a lot of money in over the next several years, okay? So in today's video, we're gonna get into 4 core subjects. One is a potential major change to the stock market that could be coming from the government side and what this means for the stock market moving forward and my perspective on this, okay? Number 2, we're gonna talk about some potential hedges I might put on after we get this first rate cut. So first rate cut should be coming very shortly here. After that's all done, right, and then we get kind of the sentiment bullish flow done, there's definitely some potential hedges. So I'll be sharing that in this video. I know a lot of people want to know about that. Okay. Third thing we'll get into today is 2 easy money stocks and why I'm buying these stocks. And I'm going to heavily buy these stocks for at least the next 90 days specifically. Okay. Fourth thing we'll get into this here in this video here today is I'm going to give you some just gems toward the end of this video on how to avoid dead money stocks. Dead money stock is when you buy a stock and you hold it over 3, 4, 5 years and you look and you're like, dude, I've made like no money in this stock. It's just been a complete like money suck for me. Maybe you didn't lose a bunch of money. Maybe you didn't go down 50% or 100% on the stock, but you just literally didn't make anything. It's like, I've been in the stock 4 years and not made any money. So we'll talk about how to avoid that in this video. One thing only I need from you guys, please, if you could do so, I just need you to hit that thumbs up button. Thank you to every single person that already did that before I told you guys to hit the thumbs up. Thank you for you guys. And if you haven't done so already, please just tap the like button. That's all I ask for this video, okay? This took many hours to prep this one for you guys. I hope you enjoyed. I hope you appreciate it. Additionally, thank you everybody that has subscribed to the channel. It is free to subscribe here to the channel if you want to see more of my videos in the future, okay? Now, if you're a long-term focused investor, you want to start taking this game more serious. You want to learn underneath me on how I built my portfolios up, all that good stuff. I invite you to apply to join my private stock group. Get access to 1000xstocks.com. That is the pinned comment down there. When you go through my library premium courses, that teaches you everything I've learned in the last 17 years up here. And you can download it straight to your brain. And you can go through those courses in a matter of weeks or a matter of months and basically get 17 years of knowledge downloaded to your brain. So it's very valuable. Also, you get access to 1000xstocks.com, my private Discord chat, exclusive weekly videos, right? See the stocks I'm buying, selling in my nearly $4 million Fidelity account, all that good stuff. Okay, that is pinned comment. Let's get you up to a higher level. Okay. All right, guys. So first off here, it's a major change that the government's trying to do in regards to stock market. And what does this mean? Well, everybody watching this video right now, you should know what earnings season is, okay? Earnings season is this beautiful time. It happens every 3 months, right? And essentially it's a gauntlet of companies all reporting their earnings, okay? And it usually happens, there's some straggler companies that might report after, but usually within like a 4-week span, every 3 months, just a gauntlet of companies will come out. These companies report their earnings. Now, the important thing is for investors, it gives us some knowledge on what the companies are doing. Are they keeping up their revenue growth, or is their revenue growth going down? Their earnings per share, what's going on with all that, right? We get to hear from the CEO, the CFO usually of the companies, and we get to hear them talk about what is transpiring in the business, right? Additionally, even beyond that, you get to understand a little bit about what's going on with the overall economy, right? Everybody knows, you have a lot of trust issues with the government numbers. So we can't trust any of the data really the government puts out for us. But what you can trust is companies reporting their earnings, saying we did this much revenue or not. And then you can get an understanding of like, is the economy good, bad, by taking all those companies and kind of understanding what's going on there, right? Now, this earnings season is very valuable, but Trump is trying to basically advocate here today that he wants to end quarterly earnings reports, okay? Now, his justification on doing this, essentially, right, and obviously subject to SEC approval, is to save money and allow managers to focus on properly running their companies. This is not really going to save any meaningful amount of money to companies. You got to understand, like, these companies are multi-billion-dollar companies. Like, the fact that they report earnings every 3 months instead of every 6 months is not any. It's literally just a rounding error on their income statement. It's a joke. Okay. He also said, did you hear the statement that China has a 50 to 100 year view on management of a company, whereas we run our companies on a quarterly basis? Not good, he says. During his first term, Trump asked the SEC to study the issue, but no recommendations came out of this. And this was obviously the top news on CNBC here today. Everybody was talking about it, okay? Here's the deal, all right? Listen, if you look at the total market capitalization of the United States companies, right, or public companies, our stock market's valued at over $62 trillion. The next closest is, guess who? China, at $11.8 trillion. Now, this is really fascinating. Why is this so fascinating? Well, China has a GDP that's not that far off of ours. Now you say, well, it's like $10 trillion off. Yeah, but as a percentage, it's not that far off. China's GDP is, right around $18 trillion. United States GDP, which is the biggest in the world, is about $27.7 trillion, right? So way less than 1x of a GDP over the Chinese GDP, right? What else is fascinating is China has about 4 times the population, about 4x the population, right? So you say, okay, China has 4x the population. They have a GDP that's not that far off the United States, right? But the U.S. stock market is over 5x bigger than the Chinese stock market. How? That's such a dramatic number. I'll tell you exactly how. Trust. People trust you got to understand, when you put your money in anything, trust is the biggest factor. It doesn't matter if you buy a house, a stock, a bond, wherever you put your money, in the bank, do you trust where you're putting that money? If you do not trust it, it's very hard for you to put your money in, isn't it? If there was a bank and you felt that the bank was about to go bankrupt, you're going to go set up an account with them? I don't think so. I don't think there's a soul watching this video right now that if you heard that bank over there is about to go bankrupt, that you would be like, oh, let me go set up an account over there. Why? Because you're like, I don't trust that. Like, I heard they might go under. Like, I don't trust them, right? When it comes to Chinese companies, people don't trust it. People don't trust the companies. They don't trust the way they report their numbers. They don't trust a lot of the data coming out of China, those sorts of things. With U.S. companies, you get these reports every 3 months, right? They're audited reports. And so you can actually trust it. And it matters so significantly. And so it's great that the United States also has, many of the most successful, dominant companies in the world. We all know that. But trust matters so much when investing into something. You start to take away trust, and guess what you get? A lower stock market. When you get a lower stock market, that could actually lead to a lot of bad economic ramifications for a lot of various reasons. Because remember, a lot of people in the United States certainly have their net worth wrapped up in the stock market. So you lower the stock market a bunch, it's not a good situation, for a lot of people that have money in the stock market, right? So my message to Trump would be, listen, if it ain't broke, don't fix it. If it ain't broke, don't fix it. We got plenty of issues in the United States of America that are worth the attention and time. One of them is not, let's take companies from 3-month reporting and make it 6-month, because all that's going to do is produce, at the end of the day, companies don't need any help executing their business models. They're doing amazing. As far as thinking long term, that's up for each individual company to go ahead and execute that. You could make an argument that 6 months, like, what is that going to change everything? No, because they're still reporting on a short-term basis. So you can say, well, let's take it out to a year. Well, maybe companies should report their earnings every 5 years instead, every 10 years, right? Then we don't even know what's going on. And that's going to lead to a lot of panic in the market. You know how panicky the market can get all the time, right? The market starts getting fearful, but what happens is every 3 months, you get a gauntlet of earnings coming in. And that simmers everybody down because they realize, oh, the world isn't coming to an end. These companies got, this number, that number. Okay, things are pretty good. You take that away and you could get panic in the market when all of a sudden people start worrying about this, worrying about that, right? Oh, I don't know if that company's number is going to be good. Oh boy. And then you got to wait 5 months to get the next economic numbers out of the company. Oh my gosh. Brutal. So if it ain't broke, don't fix it, Trump. Don't mess with this, man. Like I said, there's plenty of problems to fix in the United States of America, including the division in the United States of America. And, I think that could be addressed, but, something like this, no, don't mess with that, man. We got bigger fish to fry out there, okay? Alrighty, next up here, let's talk about some potential hedges I might put on after the rate cuts come. Then we'll get into some easy money stocks and how to avoid dead money stocks, okay? First one up of these that is a potential hedge I could do after the rate cuts come and that bullish activity concludes is Coinbase. So Coinbase is actually interesting as a potential hedge. We know crypto's been hot since really the fourth quarter of 2022, right? We know Bitcoin's been on the move, all those sorts of things. We know there's a lot of excitement about the crypto space, for the last bit of time here. But there's a potential that after the rate cuts come, we could see a chilling of the market. And that's opposite of what a lot of people think. A lot of people think, okay, rate cuts come, bullish crypto, bullish everything, Bitcoin, everything like that. There's a potential it maybe goes the other way in regards to that shortly after you get those actual rate cuts, right? And additionally, you got to understand, we're in a very, we're in a great crypto market. I mean, Bitcoin, if you go back to the fourth quarter of 2022, where was Bitcoin then? I want to say Bitcoin was was Bitcoin like 20,000 or maybe even under 20,000 back in 2022? And you look at Bitcoin today, and it's like, oh my gosh, what is it, 5x, 6x, somewhere around there? Maybe 7x? I can't remember exactly where the low was at for Bitcoin. So we've been in a massive expansion cycle. There's been a ton of money to be made with Bitcoin and Ethereum, right? And so, looking at a forward P of 40 right now, I wouldn't want to pay a forward P of 40 plus on a stock when you've already had the massive come up in regards to this asset class over the last few years. And so, I think this is something to consider here. It's very expensive for the stage in the cycle. Now, if Coinbase was at a 40 forward P and you were in down and out times for Bitcoin, if let's say this was 2022, right? Bitcoin's crashed, Ethereum's crashed, no one wants to buy crypto at that particular time, and it was trading at a forward P of 40, then you can make a very strong argument that it's a huge buy. Why? Because you're like, Bitcoin's going to come back, Ethereum's going to come back, crypto's going to come back, it's not dead forever, and you're willing to pay up for that. But when you've been in a massive expansion cycle and so fortunes of money for somebody like Coinbase to make the last few years, trading at those sorts of valuations is actually a little worrisome, okay? Next one up here are these potential hedges is good old Tesla. There's a potential I could put on a hedge against Tesla come, let's call it October, November, somewhere around there, December, right? You got to understand with Tesla, it's been in a massive hype cycle. And the hype cycle's around robots. The hype cycle's around robo-taxi, right? And even today, the Elon Musk news, Elon Musk bought $1 billion worth of shares, which, by the way, is literally nothing for him. I mean, you know what his net worth is? Buying $1 billion is not much, okay? But there's a lot of hype about all those sorts of things, right? His new pay package, $8.5 trillion market cap. There's crazy hype all over the place with Tesla, right? It's one of the most hyped times I've seen in regards to Tesla, right? Robots, if they ever become meaningful to Tesla's business model, that's not any time in this decade. You're looking at the 2030s for that, okay? And that's if that even plays out. Robo-taxi. In order for that to be meaningful to Tesla's business, you're looking at the 2030s also, right? 2026, they'll probably get in a few more cities and test a little bit more. 2027, a little bit more. 2028, 2029, maybe they get a nationwide launch throughout the United States of America and it starts scaling. But to be meaningful to Tesla's revenues, you're looking at the 2030s for that. 2030s, okay? So that's a while out there, right? Elon buying shares, that means nothing. Like I said, it's such a small amount of money for him. You got to understand when it comes to Tesla stock, it's a call or put option on the NASDAQ, basically, okay? And to illustrate this point, I pulled up a 5-year chart of Tesla and the QQQ. And what do we find, right? Tesla goes through these bullish runs along with the QQQ many times, right? And you look right here, NASDAQ peaks, Tesla peaks, and then we get that massive drawdown in 2022. NASDAQ got hit, if I recall, the NASDAQ got hit peak to trough here, 37%, somewhere around there roughly. Tesla got hit, if I recall, peak to trough around 70%. to 75%, okay? Then market comes back. Guess what comes back with the market? Tesla, right? Then we get that topping here toward the beginning of the year, and then we get the April crash, right? Tesla gets hammered, the Qs get hammered, Tesla gets hammered way harder, obviously, than the Qs, right? Then we get this comeback that we've had recently. So Tesla's just moving with the market, and it's a call or put option on the NASDAQ. And here's the thing, as long as the NASDAQ keeps rolling, Tesla rolls. As soon as the Qs can roll over, and by the way, there are time periods when Tesla can do bad even when the Qs are doing good, so that's why Tesla's kind of a little bit extra risky when it comes to that, right? But as soon as the NASDAQ turns, guess what's going to happen to Tesla? Down, down, down all the way to Chinatown, okay? So that's just the bottom line in regards to that. Another stock I'm considering potentially hedging, let's call it in the fall time, is the Hood, Robinhood. Now, here's the thing with Robinhood, right? You know, obviously the stock's been a beast the past year, up 429%. The turnaround in the financial statements is historic, right? You know, what a turnaround in the income statement in the last few years. What a turnaround in the balance sheet. They've done amazing for themselves. The issue for Robinhood, and I don't think investors are quite ready for this, is they got brutal comps to comp against in 2026. Oh boy, it's going to be nasty. They're going to have to comp against these incredible user numbers, assets under management numbers that they're all posting here in 2025, right? You got to start comping all those numbers in 2026. So the quarterly reports they're going to put out in 2026 are going to be, you know, to show major growth is going to be difficult. Very difficult for the Hood, in my opinion. You understand from the fourth quarter of 2024 through the third quarter of this year, 2025, we've had the return of the retail trader investor, okay? The return of the retail trader investor basically is just saying, you know, average Joe, mom and pop, right? Heck, I'm a retail investor technically, right? I've been doing it 17 years, but still I would be categorized as a retail investor because I don't invest other people's money. A professional is you get paid to invest other people's money, right? So even somebody like myself that's been in the game 17 years, I'm still a retail investor, okay? And there's a lot of retail traders and investors that got in the market after, you know, Trump got elected, obviously, and it's just been like a kind of a big flush. You know, people feeling bullish, like, oh, you know, stock market's going to do great, the economy's going to do great, all those sorts of things, right? Which, you know, we'll see what happens in regards to all that, but it is what has happened so far as a lot of retail investors, traders getting back in the market. That starts to slow back to, in my opinion, a very normal pace starting in 2026. So this huge momentum of just a massive influx of retail traders and investors, I think that really comes to a grinding halt in 26. And then you get back to normal growth, which there should always be some new retail traders or investors getting in the market every year, regardless, right? But in terms of the massive influx, that goes away, in my opinion, in 2026. Now, if you look at margin, we got major margin problems here, okay? So this is margin over the past year, essentially, right? We had a big expansion in regards to margin debt from about $797 billion to $937 billion. Then we had the April downfall for the market, right? And margin debt fell to about $850 billion. And now we've had a huge, epic expansion in margin debt from $850 billion to $1.06 trillion of margin debt. That's a massive expansion here, right? And so my guess is this number will likely top sometime very soon here, and then we'll go down. And why is margin debt going up so much? Well, people are feeling bullish around the market with rate cuts coming, all those sorts of things, right? And so you got to understand when that margin debt gets hammered next time, like I think it's going to hurt Robinhood pretty immensely in regards to that. Doesn't mean Robinhood's going BK or no. But you got to understand when you're priced the way Robinhood's priced, like could your stock go from $115, $120 or whatever down to $60? Like sure. That's about 50% downfall. So that's the part you got to understand. And even at $60, Robinhood would still be up massively from where it was just at the start of we can say just back in 2024 when it comes to Hood, right? Remember, Hood was $20 roughly a year ago. So this stock could go from 115, 120 down to 60 and fall 50%, and it would still be up massively. You see where we're going here? No, additionally, in regards to Robinhood, and this is a no bueno situation here, is Robinhood's forward P66. Listen, man, we're in a booming bull market. The retail trader investor's gotten massively involved in this market. We know that. And you're trading at a 66 forward P. It's not the time. It's not the time to be trading at a 66 forward P. Once again, if you're in a stock market crash, and Robinhood's trading at a 60 forward P, there's a strong argument to be made that it might be worth buying because you're saying, okay, the market won't be crashed forever. And eventually assets under management will start going up, the stock market will start going up, retail investors and traders will start returning to the market, and Robinhood's numbers will get a lot better. From here, after 2025, it gets tough to make a case that Robinhood's numbers are going to be booming in 26, 27. Very, very tough to make that case, right? No, I'm very bullish. Let me be very clear about my stance on kind of the retail investor, at least. I'm very bullish on the retail investors, over the long term. So let's say over the next 2 to 10 years, extremely bullish. I think it's been a phenomenal time to be a retail investor. I think it continues to be. The access to get educated on stocks, right? I think even the ability to use AI to get data even faster. I think things like even being able to do something like we do on 1000xstocks.com where you can listen to a conference call at 2x speed. Like that wasn't even available a few years ago, right? And now we have a feature on 1000x where you can listen to a conference call at 2x speed, or if you want 1.5x. So you can listen to more conference calls, get more information, more data, do your study faster. Tools like 1000x where you can compare all these features, like this is stuff you didn't have access to in past years. Like this is insane, right? And now you have access to it. To be able to use products like ChatGPT and others to do research, even something like we launched recently in regards to our conference calls, which is AI, which was basically where AI will go ahead and pull out the most important chunks from that conference call and feed it to you. We do that on 1000x. Like all that stuff is like insanely valuable. So, I'm not necessarily the most bullish on retail maybe the next 12 months because I think there's a good chance we have a strong pull down, at some point in this next 12 months. And I think a lot of retail that maybe has gotten a little too confident in the market without putting in the work is going to come back to bite them big. But the people that will last are the people that are doing this game right, the ones that actually know how to understand income statements, balance sheets, cash flows, that think in a practical matter in regards to the market, that know how to run valuations on companies, right? That understand forward Ps and 2-year forward Ps and what's a good price to pay for a stock versus a bad price. Those people will be just fine. They'll make it through. They'll buy the whole dip. Whether we have a small correction, medium correction, large correction, or a crash, it doesn't matter what happens. Those folks will be just fine, right? They'll buy the dip. They'll get incredible deals on incredible companies, and that will be fine. But the people that don't know what they're doing, they'll get flushed out of the market, and it'll end very badly for them. And they'll end up of just wasted money and time by, doing what they were doing essentially, which is not putting in the work, not understanding the stuff on a high level. And I could teach you it all. Like, you want to learn, you not want to learn. It's up to you, man. Make your own call out there, right? No, additionally, the consumer sentiment's bad. Like, this is the newest numbers here. U.S. consumer sentiment drops to lowest point since May. Consumer sentiment continued to slide in September, falling to its lowest point since May as tariffs seep into product prices and Americans start to spend more cautiously. University of Michigan preliminary September sentiment index released Friday declined 4.8% to 55.4%. Consumers continue to note multiple vulnerabilities in the economy with rising risks to business conditions, labor market, and inflation. Likewise, consumers perceive risks to their pocketbooks as well. This is going to eventually affect the top of the market, right? Which has been untouched by all this so far. I think there's a decent probability that it starts to touch the top of the market in 26, right? Or maybe even at the end of this year, right? Once we kind of get through the whole bullish optimism around rate cuts. People got to understand rate cuts could be coming for the bad reason. What is the bad reason for rate cuts come for? It's that you got major problems with the economy. That could happen. I don't think people have factored that in yet. People are just in the kind of the optimistic mode in regards to rate cuts. And they're kind of like, woo, rate cuts, let's go, baby. Like, stocks at all-time highs, we're getting rate cuts, we're going higher and higher. And that might be true very initially, but just understand the Fed could be starting a rate cut cycle for the wrong reasons. And the wrong reasons is the economy gets worse and worse and worse. So that's just something to factor in there. And I hope that's not the situation. I want the economy to strengthen in 26 and beyond. But, you have to acknowledge that it could go the other way here, right? And that's where if you're in the wrong companies and this economy goes like really, really south, ooh, boy, your portfolio is going to get absolutely sent to the slaughterhouse in that sort of situation, right? And, some companies won't come back from that. No, when it comes to consumer sentiment, you got to understand this, right? I posted this inside my private stock group, and I said, this is not a pro-Trump message. This is not an anti-Trump message. This is just being like like having an observation, right? When Trump came into office the first time, consumer sentiment was in a pretty good place. It wasn't necessarily great, but it was pretty good. And then, once Trump got elected and everything, like the consumer sentiment was unbelievable, right? For that next 3 years, basically, until Rona came, and then consumer sentiment obviously crashed after that. But it's a very different dynamic we had with Trump 1.0 than Trump 2.0. Because Trump 2.0, he took over consumer sentiment that already wasn't good, right? It was already bad considering, where consumer sentiment is when Trump came in the first time. But the issue is, the consumer sentiment hasn't really come back, right? It's just been kind of getting worse and worse and worse. It's come back a little bit since that April drama, the tariff drama, right? Liberation Day. But at the end of the day, we're headed right back down. And so it's a very different dynamic we have in Trump 2.0 when it comes to consumer sentiment and how the average person's feeling. I think I think there's a lot of different reasons Trump got elected, but I think, one of the reasons I knew Trump was going to win the election without even a question was I think there was a feeling a lot of Americans had that they felt like the economy was good under Trump. They felt like their life was getting better financially under Trump, right? And they still had that feeling. And so, during all those, huge inflation numbers under Biden, people kind of felt like, I don't feel better. I feel worse about my financials. And so they, thought, okay, let's elect Trump again. He's going to get things all in the right direction here. Consumer sentiment's going to boom again, and we're all going to get back to feeling great again. Well, we're going to have to see. And hopefully that's the situation. But, as of right now, I could say, it's not looking great, right? If anything, it's looking more troubling. And so, we have a different dynamic than certainly we had under Trump 1.0. And that's, and this is some of the risk I spoke about, after when the Trump inauguration happened. I did a full-scale video on why, this Trump presidency was going to be dramatically different than the first. A lot of people thought, this is going to be the first one over again. I'm like, no. It's a lot of different things and a lot of different dynamics here that you guys got to be aware of, so... And we'll see how it all plays out, but that's certainly, something that's worth looking at and paying attention to, okay? Next subject up here, we're going to talk about 2 easy money stocks and why these stocks are easy money, and then how to avoid dead money stocks, okay? So, both these stocks I'm about to share with you are both recurring revenue business models, right? They both have annual recurring revenue from their customer base or monthly recurring revenue from their customer base. Now, recurring revenue business models are the holy grail of the stock market. The reason they're the holy grail of the stock market is it's so predictable. You know what's likely coming in. Now, these companies might never shock it to the upside in terms of just posting some great numbers, but they're always there to put up good numbers, right? You're consistent. You can trust them. Remember when we talked about trust earlier? Trust is like being able to put up your good numbers quarter in and quarter out, right? That's what these companies do. They're not up and down. They're not all over the place. And additionally, remember, I spoke about, we could be going into a Fed cut cycle for the wrong reasons. We'll see. Let's hope it's not that. But if we're going into a Fed cut cycle because the economy is going to get worse and worse and worse for the next 6, 12 months, if that happens, you want to be in sort of companies that have that monthly recurring revenue. Those are sorts of business models that make it through just fine. And those are also the sort of business models people flock to if the market was in a tougher place for 6, 12, 18 months, right? Because they're like, well, at least these companies, they're not just going to end their business models or something like that, right? The opposite of this sort of business model might be like dealerships. Now, dealerships have a little bit of recurring revenue from their service department, right? But dealerships a lot of times count on selling new vehicles. And so, if you're a car salesman and the economy's in the tankers and no one wants to come buy a new, F-150 for their business or F-250, it's tough. It's really, really tough, right? So I would look at a car dealership as almost the opposite of a recurring revenue business model, right? No, I typed into Google AI. I said, what's the best business model in the world, right? And sure enough, it gave me exactly what I was kind of thinking. Subscription business models, right? Customers pay a recurring fee for access to a product or service. Examples include streaming services like Netflix and software like Adobe Creative Cloud. Then they go into freemium models and platform marketplace models, things like that, right? But it's interesting, right? And so what was one of the 2 stocks that I say is such easy money buy right now, and I'm going to be buying nonstop for the next 90 days? It's Adobe. ADBE, absolutely. I love this stock, man. I'm going to continue to buy as many shares as I can get my hands on this next 90 trading days. There's no doubt about it, right? Need to gobble up as many shares as I possibly can. When it comes to their latest earnings, which these earnings just came out, a week or two ago, they reported 10% year-over-year growth when it comes to, on a constant currency basis, when it comes to their revenue, right? 14% growth when it comes to their non-GAAP EPS. So very strong growth from the company. Do you understand with Adobe, they capture business professionals, consumers, right? A lot of large companies use Adobe's product suite. Additionally, they attract a lot of creative professionals and creators. So like people that post on, could be YouTube or TikTok, Instagram, Facebook, Snapchat. I guess if people still post on there, X, like all those sorts of places. Like creative professionals and the creator economy is huge for Adobe. And additionally, marketing professionals. Like if you're in the marketing realm, like Adobe, a lot of their products are must use if you're in the marketing space, right? So Adobe continues to just be at a sweet spot of, capturing a great amount of folks that would, want these sorts of products. Additionally, the business is very diverse. 59% of the revenue comes from the Americas, 14% from Asia. That has a lot of long-term potential. And then EMEA is about 27% of their revenue overall. So very, I would say, diversified business around the globe. It's not like they're just 100% dependent upon the United States of America or something like that. When it comes to their financial targets they just put out here, digital media, they're talking about ending the year at annual recurring revenue growth of about 11.3%, which would be very nice and strong. Earnings per share, they're talking about on a non-GAAP basis, $20.80 to $20.85. For a stock priced in the threes, that's very nice, especially for double-digit revenue growth, right? So when I look at Adobe here, like, thank you for the free money. We're talking about a forward P of 19. We're talking about a 2-year forward P of 14, right? And if the market goes lower, like I'll get Adobe for even cheaper. Like, I think that's pretty free money I'm getting here with not a lot of risk. Once again, this isn't like a business model that's up and down and you don't know what to expect. And it's like, I don't know what their revenue is going to be this quarter. No, it's just consistent. Put up the numbers. As far as my bull case, base case for Adobe, I took revenue growth down to 10% for this bull case. I took net income growth per year down to 12% from 14%, right? So I took revenue growth down and net income growth down. And yet I still get a CAGR on this one at a P of somewhere between 25 and 30, which would be fair for Adobe with these sorts of growth rates in this sort of business model, right? A compound annual growth rate on low end 19%, high end 25%. Like, got to do it, man. Got to do it. My base case for Adobe has really sleepy numbers for Adobe. 8% revenue growth on average over the next 4 years. 10% net income growth on average over the next 4 years, right? 23 to 28P still gives me a compounded annual growth rate of 15% on the low end, 20% on the high end. I got to take that opportunity. Now, also, Adobe's likely going to buy back a ton of shares of this company over the next 4 years. Going to help earnings per share probably go up at a much faster clip than 10%. It might help it go up 12 to 15% somewhere in there. So just understand this compounded annual growth rate could actually be far exceeding 15 to 20%. So Adobe, like, it's just got to buy it, man. Like, I understand some people, like, want to hate on the business model or whatever, and they have doubts about AI, blah, blah, blah. Like, I think people are just going to look back at this time period and be like, I should have bought Adobe. Like, that was just easy money. Like, it's just a drama-free stock that was just easy money and I didn't buy it, right? That reminds me of the second stock I'm about to get into. Same exact situation. All these questions about it, blah, blah, blah. Such a great company, such a great CEO that's been leading this company, just like Adobe. And that stock is Salesforce, CRM, number 2 of 2 here. This is one I need to just continue to load up on as many shares as I possibly can for this next, I would say, 90 trading days here. When it comes to CRM, right, the stock has done nothing the past 5 years. But as a new investor, I don't care. I don't care if it hasn't done anything for the last 50 years. All that matters is what's going on with the financial statements of this company, right? And it's not my fault that people overpaid for Salesforce 5 years ago. They did. They paid a bad price. They got in a bad PE ratios. And so, they paid a bad price and they paid a big price for getting in at a bad price. And that stock's down 10.5% over the past 5 years, right? The next 5 years are going to be nothing like this 5 years for Salesforce, in my opinion. We're going to see a stock that's an absolute animal this next 5 years. We'll be talking about a stock that I wouldn't be surprised 5 years from now is a $500 to $800 stock. I would not be surprised at all, just to be quite frank. Now, I spoke very in-depth about Salesforce in really the last 3 videos I did in the main channel, so I don't want to go super in-depth for 4 videos in a row in regards to Salesforce, but I just sold 1 stock and bought 3 stocks. 7 stocks you must buy before 2026. I bought a new stock today. All three of those videos, check them out if you want to hear me talk much more in depth about CRM Salesforce, because I think that one, so there's going to be a lot of money to be made in that one over this next 5 years, okay? Alrighty, next thing up here. How do you avoid a dead money stock like Salesforce has been, right? Salesforce 5-year return, negative 10%. Dead money, technically losing money, right? How do you avoid stocks like that? I'm going to give you 3 of the biggest pitfalls to avoid when it comes to these sorts of stocks, okay? First one, listen close to this segment. Dropping gems here, okay? Paying sky-high valuations. You want to pay sky-high valuations. In the short term, it could actually pay off. I've seen a lot of stocks that are just at ridiculous valuations go up to even more ridiculous valuations. And you look at the forward P and you're like, dude, there's no way people are going to make money over the stock over the next 10 years. Like, there's no way. But that has no ramifications on the next 10 months or the next 10 weeks. So over the next 10 weeks and the next 10 months, that stock could go up even higher and higher and higher. And yeah, maybe that stock doesn't make people any money over the next 10 years, but it could make people money over the next 10 weeks or 10 months, right? But if you pay a sky-high valuation, you're setting yourself up for dead money as an investor potentially over a 5-10 year span. And you look back and you're like, I've lost money on the stock, or I've hardly made any money and I've been in it 5 years? What? Like a CRM situation, right? So a good example of this, I want to give you guys some real life examples here. Palantir, I wouldn't touch the stock with a 10-foot pole at these prices. With that being said, Palantir could go to 200 in the short term. I have no clue where Palantir is going to go over the next, 3 to 9 months. I could go 200, could go 250, could go 300, right? Or maybe it tops at 175. I don't know. But I would not touch it with a 10-foot pole at these prices, right? Which is why I've sold the far majority of my shares. I only hold 1,000 shares. And that 1,000 shares is just in case I'm wrong on Palantir, and maybe they grow at like a 50% plus revenue number for like the next 5-10 years. Because if they grow at a faster than a 50% revenue clip for at least the next 5-10 years, then you could make an argument that Palantir could still actually be a moneymaker here at these prices, right? I have a lot of doubts about Palantir growing at a 50% plus revenue clip for the next 5 to 10 years straight. I have a lot of questions about that. I don't think that's super realistic. Although, still being a shareholder of 1,000 shares in the public account, still owning a little bit in other portfolios, I wouldn't mind that, but I wouldn't touch it with a 10-foot pole. Here's a deal with Palantir, right? 295 forward P, a 202-year forward P, right? I mean, this stock is setting up for a horrible 2026 to 2030. But once again, over the next 3 to 9 months, it's anybody's best guess what happens with Palantir. But I'm just telling you, when you got a forward P and you're already, Palantir's already been a profitable company for a bit now. When you got a forward P at 295 and a 2-year forward P at 200, right? Remember, a 2-year forward P, a lot of stocks are under 20, usually in the market. So you're over 10x. I think the stock's setting up for a horrible 2026 to 2030. I think the stock's either going to be flat, from basically the high it hits this year in 25 to, let's say, in 2030. I think the stock will either be flat or have lost people money. And so we'll see what happens, but you got to understand, when you pay a sky-high valuation, man, you're setting yourself up for problems. And I've seen it continuously in the market over time. People will pay crazy prices for stocks, and then over a 5-10 year span, they have nothing to show for it. Nothing. But in the short term, who knows? Number 2 of these things is focusing on the hope rather than financials. This is an issue I see continuously in the market. People hope a company's going to do blah, blah, blah. They're not looking at the financial statements. They're not really looking at the income statement, the balance sheet, the cash flows. There's, this some bullish narrative around that stock, and they're like looking at that and they're like, this is like the next big thing because of blah, 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 right? When the financials are showing you the company's actually in a lot of trouble, right? A good example of this, and if you follow me on X, I get them going, man. I get them going. Look at this post. I just did it 5 hours ago. It already has 233,000 impressions on X, man. We get some views on there, right? And by the way, if you ever want to follow me on X, I always have it linked in the description area of all my videos. But, I put this out. I said, I can't believe people are really buying Tesla stock in 2025. This is a year to sell Tesla and get out, not the year to buy. You have to learn the hard way. Oh, well. And, Tesla's financials are for the dumpster. We all know that, right? Like, it's bad. But there's a lot of hope around Tesla, right? The robots, right? Which, once again, that's not mattering anytime soon. The robo-taxi, which, someday could be a big business for Tesla, but it's not anytime soon. The car business is a disaster. The energy business growth rates have been going down substantially. Like, it's just... it's not a good situation, but the stock is hyped right now. It's got the hype behind it. And so it's moving up, but, I think that setup is not a good setup. Not a good setup at all. So the moral of the story is, the same thing has happened with Tesla in the past. If you look at the stock, where it topped at back in 2021, it was right around the price it is now. And that was back in 2021. And that was in another hype cycle. But that hype cycle was different. That hype cycle was around EVs and how Tesla was going to be dominating in EVs, right? And around the dojo and all that sort of stuff, right? And dojo, I don't even think they're doing that anymore at this point in time. And we know EV sales for Tesla have collapsed. So these narratives come with Tesla, and it's like, oh, everybody's going to do this. Oh, they're going to be selling a trillion, billion, badillion robots. And it doesn't happen. And people are like, oh, and then the stock gets absolutely obliterated. And then, it goes through another hype cycle. So do understand that in regards to Tesla, it's, an ugly situation there, okay? Number 3 is buying a business in decline. You buy a business where the revenues are going down and they continue to go down. Doesn't matter what forward P you paid for that. You could pay a trailing 12-month P of 6 on it. If the business is in decline, no one's going to want to buy that company. No one's going to want to buy that stock. They're going to look at it and be like, I'm good. Thank you very much. Like, I don't care if it trades at a forward P of 5. Doesn't matter. It could trade at a forward P of 3. And people are like, if the business is in decline, they don't want to own it at basically any price. All right, 3 might be a little bit excessive, but you get the picture here. If people feel like those revenues of that company and the profitability is just going to keep going down in future years, it doesn't matter the price. They're not going to buy it. They're not interested. And so you buy a business in decline, you can set yourself up for dead money in a stock for years and years to go in the future, okay? Hey guys, if you like learning under me, you want to take your knowledge up to a much higher level, apply to join my private stock group, private wealth group. That will be the pinned comment down there. Get access to all of my premium courses, access to my private Discord chat, exclusive weekly videos, all the moves I'm making my nearly $4 million Fidelity account. And when you join us in there, we'll get you your Steel membership cards and all that good stuff, guys, okay? Appreciate you joining me. Much love as always, and have a great day.